Hello, I'm called Jingo Nelly. Welcome back to another part of the financing decision, and we are going to be continuing with the second theory, that is the neoclassical school of thought, or the theory. And before I begin off, I'm going to require you to subscribe and also follow what I'm pointing at, because I'm already having properly well explained, laid down information. So with this, they're saying this school of thought is campaigned by Modiglian and Miller, the two Indian scholars, and it's commonly referred to as the theory. So, who argue that the financing structure is just a mere detail with no impact on the value of the firm. So, the contention of this view is that the firm creates wealth from the stream of cash flows from the real assets. According to them, the financing decision is subordinate to the investment decision. So, therefore, they say wealth can only be created from the cash flow potential of the stock of assets in which the business has invested. So, according to the theory, wealth is created via the investment decision other than the financing decision. Therefore, once a given level of wealth has been created from a stock of assets of a business, this cannot be altered by a variation in the financing. So, an analogy of sharing a cake can be used to further explain this concept of conversion of value. If you have a cake, in whatever way the cake is shared, it cannot increase its size. The only way to increase the cake is to bake another one. Similarly, the way to increase the value of the firm is to change the asset mix. Otherwise, the financing mix does not affect the value of the firm. Then I'm having an example. Suppose you have assets worth Uganda shillings 20 billion with expected future net cash flows of Uganda shillings 100 billion. These assets could be financed 50% equity and 50% debt, or 25% equity and 75% debt, as shown in the two diagrams below. So we have the diagram of case 1, which is financed by equity 50% and financed by debt 50%, and case 2, financed by equity 25% and financed by debt 75%. So meaning that in whatever way, still they will give you a total of 100%. So the wealth of the business, according to the theory, will remain 100 billion irrespective of the change in the financing proportions. The wealth can only increase if the business acquired more assets through the investment decision, and hence increase the capital to generate additional cash flows. So moving on, in relation to cost of capital, Modiglian and Miller argue that different portions of debt and equity financing will not have an impact on overall cost of capital for the business. According to Modiglian and Miller, overall cost of capital will remain constant for all levels of debt and the equity combinations in the capital structure. So when the leverage increases, holders of equity securities perceive increased risk in their expected dividends. This is because more of their earnings will go to meet the interest finance costs of borrowing other than for dividends. So, to reflect this increasing risk, as leverage increases, shareholders increase their required rate of return or cost of capital as long as leverage increases. When leverage increases, their interest and other cost of debt financing will increase as well, since the interest costs are tax deductible for the purpose of determining taxes payable by the business. These costs provide a tax shield, which is an advantage to the business. The bigger the tax shield, the lower the cost of debt also becomes. So according to the theory, the increase in the cost of equity due to potential bankruptcy, costs of increased leverage. According to the theory, the increase in the cost of equity due to the potential bankruptcy cost of increased leverage is offset by the decrease in the cost of debt due to the tax shield associated with increased leverage. thus cancelling out each other and leaving overall cost of equity unchanged. Cost of equity will therefore be constant for all levels of leverage, implying that there will be no optimum capital structure at which cost of capital is minimized and the value of the firm is maximized. The individual business will therefore choose a particular portion of debt and equity consistent with the risk preference of its managers, as well as taking into account the other factors that affect the capital structure. So the theory makes the following assumptions to justify their position. There are many buyers and sellers of securities such that no party can single-handedly determine the prices. There are no transaction costs. There are no taxes, both personal and corporate. Securities are completely divisible. There are no bankruptcy costs. Investors are fully rational and base their decisions solely on risk and return, meaning that they know what they want. Institutions and individuals can borrow and lend at the risk-free same rates. So that's it for today. Make sure you subscribe. Next will be the middle ground debate.